For basically all of human history, we've been on a quest for something called sound money, a way to store value that you can trust over the long haul. For centuries, the undisputed champ in that ring has been gold. But now, a new digital challenger has appeared, Bitcoin. So today, we're going to see a showdown for the title of the ultimate savings asset.
So let me ask you something right off the bat. Imagine you had to put your savings into one asset, lock it away for 100 years, and you couldn't touch it. What would you pick? What would you trust to still be valuable for your great-grandkids? Well, the answer really boils down to a handful of key traits, and that's exactly what we're going to unpack.
So let's talk about the search for hard money, and really why your savings need a shield in the first place. You might be wondering, why can't I just stick my cash in a savings account and call it a day? Well, the hard truth is, the money in your pocket is pretty much designed to be worth less tomorrow than it is today. And here's why. The money we all use, dollars, euros, yen, it's called fiat currency. And what that really means is it's not backed by anything physical. Governments can just print more of it whenever they feel like it. And when they do that, you get inflation. It's like this silent thief that just eats away at the value of your savings year after year. For thousands of years, humanity's go-to defense against this was gold. Why? Because you just can't print more gold. All right, so let's talk about scarcity, this tale of two assets. This is really the ultimate measure of value. You see, if we're going to properly compare gold and Bitcoin, we need a way to measure how scarce they are, like with actual numbers. It's not just about the total amount out there. It's about how much new stuff gets added to the pile each year. And lucky for us, there's a perfect tool for this called the stock-to-flow ratio. So what on earth is stock-to-flow, or S2F? It sounds complicated, but it's actually super simple. The stock is the total amount of something that already exists, all the gold ever mined, for example. The flow is the new amount that gets produced each year. The best way to think about it is like a lake. The stock is all the water already in the lake, and the flow is that little river trickling into it. The bigger the lake is compared to that tiny river, the higher the S2F ratio, and the more scarce and hard that asset is. And this is where it gets really fascinating. Let's look at the actual numbers. Gold's stock-to-flow ratio is around 62. That's incredibly high. It means at today's mining rate, it would take 62 years to double the entire existing supply of gold. Super scarce, right? But now, look at Bitcoin. Its S2F is 121. That's not just a little higher, it's nearly double that of gold. So based on this cold, hard metric, Bitcoin isn't just scarce, it's mathematically the scarcest asset we've ever known. Okay, so why the huge difference? What's going on here? It all comes down to one simple concept: elasticity. Gold supply is elastic. That means when the price of gold goes up, it gets more profitable to mine it. So companies pour more money into technology to find and dig up more gold. More price, more mining, more supply. But Bitcoin, its supply is completely, totally inelastic. It's written in code. The schedule for new Bitcoin is locked in and cannot be changed. The price could go to $1 million tomorrow and it wouldn't make a difference. In fact, the new supply actually gets cut in half automatically every 4 years in an event called the halving. It's predictable, transparent, and absolutely unstoppable. Now, scarcity is obviously a huge deal, but it's not the whole story. To really work as money, an asset needs to check a few more boxes. So let's look at the 6 traits of money. You can think of it as the official rulebook. All right, here they are, the 6 big ones that economists agree on. You've got durability, portability, divisibility, uniformity, which is also called fungibility, that limited supply or scarcity we talked about, and finally, acceptability. Let's see how our contenders stack up. So when we put them head-to-head on the scorecard, things get pretty clear pretty fast. Gold is a champ when it comes to durability, right? It literally lasts forever. But try moving it around, or dividing it. Good luck trying to carry $1 million worth of gold through an airport, or shaving off a few cents to buy a cup of coffee. It's just a massive headache. Now, Bitcoin, because it's purely digital, just completely crushes it here. It's weightless, you can send billions across the planet in minutes, and you can divide it into 100 million tiny little pieces. And that's not all. Bitcoin is also perfectly fungible, meaning one Bitcoin is exactly the same as any other. But here's its real knockout punch: absolute verifiable scarcity. There is a hard cap. We know with mathematical certainty that there will only ever be 21 million Bitcoin created. Ever. You just can't say that about fiat money, which we know can be printed into oblivion. And you can't even say it about gold. Who knows how much is still in the ground or on asteroids for that matter. Okay, so this brings us to a really, really important question, maybe the most important one of all. This goes beyond numbers on a chart. It's about control, your money and your control over it. Let's talk about sovereignty and seizure. So, what do we mean by individual sovereignty? Put simply, it's the idea that you and you alone control your wealth. It means no one, not a bank, not a government, can freeze your account or just take your property without your consent. It's about true financial ownership. So, how do gold and Bitcoin stack up on this front? Well, history gives us a pretty chilling example. Back in 1933, with just the stroke of a pen, the U.S. government signed Executive Order 6102. And just like that, it became illegal for American citizens to own most forms of gold. They were forced to hand it over to the government. This was a nationwide mass confiscation. And it was only possible because gold is physical, and most of it was sitting in bank vaults, a single central point of failure. Now, I know what you're probably thinking. Hang on, I see headlines all the time about the government seizing Bitcoin, and you're not wrong. The numbers can be huge, like you see here. But, and this is the absolute key, there's a massive difference between mass confiscation and targeted forfeiture. The gold seizure in 33 was a blanket order affecting millions of everyday people. The Bitcoin seizures you hear about today, they're targeted operations against specific criminal organizations who got slobby. The reason for this difference is self-custody. With Bitcoin, you can hold your own private keys, basically the password to your money. There's no bank in the middle. A government can't just call up the CEO of Bitcoin and tell him to freeze everyone's accounts. It's physically impossible.
And this quote sums it up perfectly. If decentralization prevents blanket orders, then individual sovereignty is bolstered. What that really means is that Bitcoin's lack of a central leader or headquarters is its greatest defense. It's the very thing that makes a 1933-style seizure nearly impossible to pull off today, and that directly protects your personal control over your wealth.
So, as we wrap this up, we're left with one final powerful question. Gold has been humanity's shield for thousands of years. Bitcoin is the new digital contender. Both offer an escape from endless money printing. But in a world that is becoming more digital every single day, you have to ask yourself, which asset truly gives you, the individual, more control? Which one puts you firmly in the driver's seat of your own financial future? That's the choice we all have to consider.